Well, during his career, he's worked on deals ranging from Dell's acquisition of Compellent and IBM's purchase of Netezza. Now, Eric Mandl is working on deals at Evercore Partners as a senior managing director. And he joins me here on set in New York. Eric, welcome to Bottom Line. Pleasure to have you on.
It's great to be here. Thank you, Mark.
You were just paying attention to our Ian Adewuya, who I know you know, and he was basically giving us the landscape of what's going on in M&A. Even with the recent string that we've had of subpar economic news, is the time ripe for M&A?
It most certainly is. The most interesting statement that Ian made was this threshold that we've crossed, the $1 trillion threshold, if you will, which is so material, not only in the world of M&A, but especially in my world in technology. There is so much cash on the sidelines right now. And to me, when I see that threshold crossed, that means that cash is being deployed in an M&A perspective rather than from a buyback perspective or from a dividend perspective or just letting it sit on the balance sheet.
So was the cash just on the sidelines waiting for a good deal? Because as Ian pointed out, everybody else waits for somebody else to jump into the pool first, and then they say, okay, it's all right for us to dip in too.
You know, we live in a world of cat and mouse in M&A. It's extremely difficult to figure out who's going to have that first mover advantage. And there's a lot of stress at the CEO level and the board level to either make sure that you're not overpaying, but also to make sure you're not missing an acquisition. There's a very interesting statistic that just came out recently. There's approximately $1 trillion of cash when you look at the kind of the top 3/4 of the S&P 500 companies that have yet to be deployed. So what that means to me is, even though we've seen all of this M&A, we actually are positioned well, arguably, for an even greater round of capital being deployed.
So my colleague Ian was correct then when he pointed out, he said that we're in a sustained M&A cycle and a sustained upswing.
Absolutely, and I think a lot of people like to create a link between the equity market and the M&A market, and I think you can. I think sometimes when the equity market pulls back and you're a very large multinational tech player, it creates a nice situation for you to pick and choose. But by the same token, the concept that you were mentioning earlier, what if I'm not that first mover advantage? What if I'm the guy that is coming late to the party?
You're on the platform when the train's pulled out.
Exactly, and that's not a good situation when you have to go back to your board and say, I couldn't win that asset. And in tech, the thing that sets tech apart from a lot of other subsectors is that when a company that is truly unique trades and is gone, it's gone. It's not replaceable, so you have to buy it.
What does this say right now about how tech has weathered the recession?
Interestingly enough, you could argue, if you look at the way earnings have been growing, the way revenue has been growing, and also I think one of the greatest litmus tests, even when the market is challenged from a trajectory perspective, and we have a challenged global market today, but there are IPOs that are able to get done, and those IPOs are very germane to technology. There's a lot of interest in being able to play themes that you can't necessarily play by owning large cap technology companies.
Are the deals we're seeing more strategic or more for value?
Far more strategic. And that always raises the question of, are we in a bubble or not? Is there a lot of pressure on companies to pay up? And I would argue that the way the market really works is there are buyers and sellers. If someone is willing to sell at a price and someone is willing to pay that price, you have a transaction. And arguably what we've seen, especially in technology, is you have multiple bidders going for the same assets, which creates a great situation for M&A.
Eric, a lot of overseas companies like what they see here in the U.S. and they're willing to expand. And earlier this hour, our Peter Cook interviewed Commerce Secretary Gary Locke. Basically, the shingle's out. We are telling foreign direct investors that the U.S. is open for business. Is the reverse true for the U.S. going overseas?
It absolutely is. It's a fascinating question. I think one of the most interesting concepts going on in the world of tech right now is a lot of the large cap companies have a huge amount of cash that they have generated outside of the United States. And when you generate that cash, it's actually prohibitive from a tax perspective to bring it back in. So how do you deploy it? And one of the best examples of this is Microsoft's recent acquisition of Skype. That was all foreign cash used. I think we'll see more of that. The problem is you need to find targets that are large enough outside of the U.S. in the world of tech.
And that foreign cash, because the U.S. cash overseas, the tax rate being 35%, they don't want to bring it back.
Exactly. It's a lot easier to deploy it outside of the U.S. if it's trapped.
Eric, IBM and Oracle, they are normally active in the M&A space, and they haven't been this year. Any idea why?
I think all large cap companies need to make sure that whatever moves they make makes sense. One of the toughest things, I was speaking to a number of CEOs in Silicon Valley last week that are CEOs of smaller companies, and they're trying to figure out who's going to buy them, who might be interested in them, do they go public? And what's interesting is the larger companies need to deploy their capital in a very smart way. They want to be able to deploy it so that they win in whatever segment they're trying to win in, but by the same token, they don't want to get into a situation where they're the only bidder for an asset.
Given that tech internet seems to be hot these days, at Evercore, you going to expand the bankers? You guys going to hire more?
Well, we're extremely focused on this segment. There's a piece of data that you'll find fascinating. More data has been created and stored in the last few years than in the last 10,000. So if you think about that, every book that's ever been written, everything that's ever happened, that has all been replaced in the last few years. That has created so much focus on not only internet, but data management, and that's where we're spending a lot of our time.
Can Apple, which has a huge hoard of cash, can we expect them in the space as well?
I think you could arguably say any company that has a lot of cash on the balance sheet, whether it's in the United States or overseas, is looking to figure out how to better shore up their intellectual property and better compete with those fierce competitors. So the screen is pretty tough to narrow down to just a few companies because everybody's on the prowl.
Last year, we did see that overheated bidding war between HP and Dell to buy 3PAR. Is that a thing of the past, or does that re-emerge when you have entities going at it like that?
I think the one thing that we did see there and we could see again is that there are assets that are out there, as I was mentioning earlier, that once they're gone, they're gone. And if you believe, as a person running a company, that if you can't get that asset and win versus the other big guys that are trying to eat your lunch, you're going to be in a very tough spot. That can create those types of situations. That was an extreme example, but we can't count out that it couldn't happen again.
Dodd-Frank, is that indirectly leading to a surge in M&A? And I ask that because we're seeing a lot of big banks unloading units that they believe could pose a risk.
Technology is an interesting, odd part of the economy in that you have so many new entrants into technology all the time. I mean, a couple of buzzwords we hear all the while: cloud, social networking, all these companies. Some of them didn't even exist a few years ago, and they have become such major players today. So you could argue from an M&A perspective, it's being driven in tech far more by what do I need to own in order to win, rather than what is pressuring me to make acquisitions.
You've just been at Evercore for a few months. You started this year. You were at UBS before that. Yes. How did that position you for what you're doing now at Evercore?
Well, I consider myself very fortunate to be at Evercore. It's an amazing team, and what I love to do is technology. I love to do it from an intellectual perspective. The beauty of the platform I'm on right now is that Evercore is 100% focused on just providing advice. So the ability to go into a board, sit across the table from a CEO and say, this is what I think you should do, or perhaps this is what I think you shouldn't do. Maybe sometimes not doing the deal is the right answer. That's a wonderful thing for me to be able to do.
Before I let you go, I have to ask you, because the way that M&A has heated up, and again, we mentioned that $1 trillion figure.
Yes.
Could that be indicative of the economy as a whole, that if we see M&A heating up and there is confidence in boardrooms to make these deals, does that confidence then trickle down? Can we get a sense from firms around the country that if they're willing to take the risk, they must see something in the economic climate that's positive, notwithstanding all the negative numbers we've been getting?
I think an argument can be made, absolutely, that when you see M&A moving at the pace it's moving, and you see companies comfortable deploying their capital, spending their time, spending their resources to make acquisitions, that's only a good thing.
Eric Mandl of Evercore Partners joining us here on set, and as I mentioned during the break, proud graduate of Stuyvesant High School here in New York. Pleasure to meet you.
Pleasure to meet you. Thanks so much.
Thank you. Coming up next on Bottom Line, confidence among home builders is in the cellar. We'll talk about that with the chief economist at the National Association of Home Builders. He joins us after the break. Stay with us.